Up next now, I need to bring up our next presenter, who is Anthony Chang with AnchorVest. So, Anthony, I'm getting you up on the stage right now. And while I do that, I'll tell you a little bit about Anthony. Anthony recently just joined my OZ Insiders Mastermind group, and his project is in collaboration with developer Sinatra Company. They're doing a ground up development of a Class A multifamily opportunity zone project in downtown St. Petersburg, Florida. Anthony, there you are. How are you doing?
Great, great. Thank you.
Good to see you. Good to hear you. Anthony, you've got a 20-minute presentation, and the floor is yours for that allotted time. So please dive in when you're ready.
Great, great. Well, thank you, everybody. Thanks for the opportunity to present this project. We're very, very excited about it. Just wanted to, before we get started, give you a little introduction about myself. I was formerly a McKinsey consultant. After that, I actually did an internet startup during the first dot-com boom. We went public. I wound up selling the company back in 2000, and then I moved into real estate development in 2001 in Los Angeles. Kind of fast forward 20 years, I built a couple of projects, and one of them I was selling had a big capital gain. So how I actually stumbled into the opportunity zone industry was because of placing my own capital gain. And that's when I actually ran across a company called Sinatra Company, I believe in one of Jimmy's events, roughly about 5 years ago. So thank you, Jimmy, for putting that all together. And now moving forward, we've done a bunch of projects together. I first started off as an investor myself, and then quickly worked on a subsequent project with Sinatra Company. And now my firm, AnchorVest, we're an alts investment manager. We have a programmatic relationship where we're working on OZ projects as well as other value add projects. So I come in as an investor, a consultant, almost like a co-GP on these deals, and we're really excited about this one. So just a little bit, I have to put up the disclosure here. Lawyers require it. These are forward-looking statements. And if you're interested in the offering, please contact me and we will send you full documents on that. So first off, I'd like to just tell you a little bit about the partner here, because when you're in an OZ deal, you're in it for 10 years. You're really marrying the developer if it's a real estate deal. And what I really fell in love with Sinatra in the beginning is that they're quite established. They've been around for 15 years, 16 years now. And currently they own about 4,000 multifamily units, about 700 million in AUM, and they have about 150 team members. That's spread across a couple offices up in Buffalo, New York, for their Western New York operations, and then also down in Tampa for all of the Florida properties. The founder is Nick Sinatra, hence the name Sinatra Company, and real great CEO. He's Yale undergrad, Wharton for business school, and he really formed the company to make an impact on his communities. He was born and raised in Buffalo, comes from a blue-collar background, and now has really built up an amazing company, particularly in the places where he's based, because he is from Buffalo, so he wanted to really develop that area. And now he also spends half the year down in Florida. The other partner in Sinatra Company is Anthony Nanula. His family, the Nanco family office, they made their original wealth in the top supermarkets chain in Western New York. And since then, his generation of himself and his brothers, they actually work in their operating companies that they make investments in. So Anthony is the chief investment officer of Sinatra. He's also a former New York State senator. And what I also really appreciated about working with Sinatra and when I first invested is that Nick was a former staffer in the White House. And between the two of them, they really understand the political system and can really dig into new legislation, programs, and what I call tax goodies because of their knowledge of how the political system works. So Sinatra Company is vertically integrated. They do their own acquisitions and investments. They manage their own construction and development. And of course, they have their own property management firm. So by having all of this integrated, you actually generate alpha, you save on expenses, and you have one integrated system from beginning to end, which is very important for an OZ project because, like I said, you're in it for 10 years. And in this way, you can actually control the entire ecosystem. Now, over the years, Sinatra has actually developed a couple dozen projects. Most of them were in the Buffalo area. And out of these, there were a handful that were OZ projects. And actually, I have co-invested in pretty much all of these, as well as been a kind of a partner with Sinatra on these deals. I started off 5 years ago with the first one with Mid-City Apartments. And what really drew me to these opportunity zone deals were the fact that they would bundle in some other type of tax benefit. So for these deals up in Buffalo, New York, they were actually twinned with brownfields tax credits or historic tax credits, and that really drove up the juice in the deals. This takes a lot of understanding, a lot of patience, and also you really have to make sure you know your tax law to make sure that these deals work and that the investors get their full value out of it. Now, out of these deals, these three, actually there's four of them now that have completed construction. They were all completed on time, under budget. So I really like the performance of them. Now, on the other side of Sinatra, they also do just your kind of bread and butter value add deals where they buy older apartments, renovate them, raise the rents and the NOI, and sell them. They've exited out of 21 projects now, and they've averaged 21% IRR. So overall, performance has been strong for investors. Now, on these OZ deals, there's a couple of different advisors. My firm AnchorVest, we help with a lot of the OZ compliance and structuring. As I mentioned, we also co-invest in these deals. Our attorneys are Snell and Wilmer, and we work with Cohen and Company on the accounting side. So we really have great folks helping us on the deals from beginning to end. Also wanted to mention that we do also get ourselves involved in a lot of the trade associations. We're in with Jimmy on the OZ Insiders. We're part of the Novogradac OZ Working Group. So we really stay at the forefront of all of the legislation that's changing. And we're real big sticklers on compliance, which is very important for an OZ deal to make sure you get all your benefits, particularly after 10 years. So let me tell you more about the project in the area now. One of the things that we've done is we've really migrated our focus down into Florida. And with Florida, Sinatra Company set up a Tampa office. And there's a couple of reasons. I'm sure all of you have heard in the media. There's been a big migration of companies, jobs, workers. And the forecast right now, just in the next 5 years, is another 1.4 million new residents into Florida, of which a lot of them are going into the major cities, particularly Tampa Bay. Two other things. One of the drivers behind this is not only the companies moving there, but there's no state income tax. And there's no rent control. In fact, there's actually a law prohibiting rent control from coming in. So as a landlord, as a developer, this is really important to protect the projected rent increases that we have in our pro formas and budgets. Now, particularly about Tampa Bay, because this project's located in St. Pete's, which is in this little pocket here in Tampa Bay. Tampa Bay has seen some of the biggest migrations. It was ranked as the #2 best city, best large city to start a business, and one of the best places to live in Florida. And then within Tampa Bay, we have our Tampa office really to help out, oversee all the projects that are going to be in St. Pete's and Tampa. We currently own about 1,100 units of apartments in the area. So we do have teams on the ground. We have about 40 folks already in the office there. And we also have construction management down there. So let me tell you specifically about the project now. This is called Solmar St. Pete. It's an 18-story Class A high-rise, 266 units. It's a beautiful project, all luxury. And as we heard on some of the other deals, this is a particularly nice OZ. It's not in a rough area, but it has been a rough area. And that's because it's been in the path of progress. When I mentioned this area called downtown St. Pete's, I'm really talking about the area that is bordered on 3 sides by highways and then the other side by water. So downtown St. Pete really is constricted in terms of its growth. You really can't go beyond these and still be downtown St. Pete's. And this property is right here on the west side, which is basically some of the last developable parcels. Everything up and down Central Avenue in the middle, and in particular, everything on this eastern side has already been developed up. There's tons of high rises, there's housing, there are jobs immediately in the area. There's dining, shopping, and in fact, from the location of Solmar, you're literally a 2-minute walk to Central where you can have access to all of that dining and shopping. So the location is really unbeatable in downtown St. Pete, which is one of the highly sought after cities to move to in Florida. Now, here's a more of an aerial view from the west to east view. You can see the waters on this side. All the downtown office high rises are in the back. Tropicana Field, unfortunately, got damaged by the last hurricane, but we also have, what we really like to position ourselves nearby are also the universities. So we have University of South Florida here. We also have hospital systems. So there's a lot of drivers of tenants. There's a lot of drivers of employees, particularly those that are looking for workforce housing and those looking for luxury in this particular area. One other thing I wanted to point out is downtown St. Pete's, given the development landscape over the last couple of years, there have been kind of a fewer number of projects. And so the good thing is with this project launching construction in January of 2026 and completing in 2027, at the time that we should be complete, there's going to be what we call kind of the donut hole in terms of new units coming online. So absorption, we expect to also be faster for renting those units and reaching stabilization. So overall investment timeline, we're looking to finish the raise this summer, hopefully no later than October. Construction will commence in 26, finish in 27. Will be leased up probably around in 28, halfway into 29. During this period, once construction finishes, as we mentioned in some of the other presentations, there's going to be a huge amount of bonus depreciation that hits. And then we also have the refi once we hit stabilization in year 4. This particular project, given its high-rise nature, we brought in some experts as the development team. We're working with Verdex. They're high-rise experts right here in St. Pete's in Tampa. And the architect is Baker Barrios. They're also experts at high-rises, institutions, multifamily. So we're really proud to have them. We also have a development partner that is a local development firm, Gemini RE Development, who they've built billions of dollars of mid-rise buildings all around Florida. And so we're happy to have them on board to help out as well. So now getting into kind of the nuts and bolts of the returns, when we look at OZ deals, we like to break it up and then we like to look at things post-tax, including all of the OZ benefits. So you can really get a true sense of what you're earning at which point. What we like to point out in our deals is when we include bonus depreciation hitting and having that factored in as kind of a benefit because it does decrease your taxes, and then also having the refi hit, we expect that an investor can have 100% of their initial investment out by the end of year 5. And in fact, in this case, we're already forecasting, given the refi in year 4, that 94% of your capital is already out. We also factor in the fact that you have to defer your original capital gains and then you have to pay it. Right now, currently, that capital gains payment would be made in 2027 because the deferral is only to 2026. But overall, this project for a New York State investor is forecasted at a 21.3% IRR and a 3.7 multiple on invested cash. So for us, we feel that this is quite attractive. And one of the things that we do here at AnchorVest and at Sinatra is, for those of you coming from other states, we actually do calculate what those states would provide you in terms of tax benefits and tax rates. So you get a true detailed image and projection of what your returns will look like. Now, some of the key terms, we can distribute this afterwards. We're pretty much in line with the market. There's an 8% preferred return, which is really valuable for investors. And then we do a standard typical waterfall, which is an 80-20 up to a 12% IRR, 70-30 to a 16, and then 50-50% above that. So we do feel that these hurdles are quite generous compared to the market. And typically there's kind of a higher fee for OZ management deals. And this one, there's only a 1% fee, but that's not even based on capital. It's based on gross revenue. So there is an incentive for the developer and the sponsor in this case to make sure the project performs well in order to get these fees. I do want to mention as besides the St. Pete's deal, we do have other OZ deals. Because Sinatra Company is based in Buffalo, we have another project called the Sinatra and Snow Fund. if any of you are football fans, Deion Dawkins from the Buffalo Bills is a partner in this particular fund. This is a smaller deal where it's 42 million in development. It's 3 smaller sites, all historic preservation. So this deal actually earns historic tax credits, which are also super valuable. And then we, of course, layer on depreciation. So if any of you are interested in this one, please let me know. One of the nice things when you actually layer on historic tax credits on top of opportunity zones is that you can also get out early return of capital because those tax credits are either applied to your tax bill, or in the case of state tax credits for New York, they're actually issued out to you as a check by the state. So it's a fantastic program. This one has 3 underlying small projects that are all mixed use or multifamily in nature that will be performed in 25 and 26. That one already saw a first closing, and we're expecting this one to pretty much get wrapped up in the next month or so. So if you have any questions, please feel free to contact me or the CIO of Sinatra Company, Anthony Nanula. I think Jimmy's probably going to drop my contact information, my email, and you can reach out to me and we can send you full offering docs.
Awesome, Anthony. Thank you. We've got a few minutes for some questions. I did post your email address, acheng@anchorvest.com, in the chat just a few moments ago. So please don't hesitate to reach out to Anthony if you'd like to request offering docs, or if you'd like to get on the phone with him and ask him some more questions. We've got quite a few questions in, Anthony. We've got a few minutes to answer them. First question is, there's a lot of chatter about certain markets in Florida that are losing money due to climate changes, high HOA fees, et cetera. I know insurance costs in particular have gone way up in large parts of the country, but in particular, Florida. How does Tampa compare to some of those cities in the area?
Yeah, these are great questions. So the benefit of working with Sinatra Company is we already own 4 different projects in Tampa. And actually, insurance rates have come down below all of our forecasts. That's been very, very promising for us. We've actually been in the market for roughly about 5 years. We've gone through multiple hurricanes. We've seen insurance rates go up. They've come down, and many more insurers have come back to the market in 2024, and a handful more are coming in 25. So insurance for us is not an issue. That's all been budgeted into these pro formas. So we're pretty confident there. The other thing is, I see there's a question on kind of more new developments coming up in St. Pete. One thing here is that the population is continuing to grow. There's also some movement between Tampa and St. Pete. And so when we're forecasting demand, we're also looking at when these units are available, how many people are moving in, and what other new developments are coming on into the market. So for this particular project, we forecast construction to be completed in December of 2027. So we're really looking at absorption in 28. And at that time, we do feel that there's going to be sort of a issue with supply. And so we expect absorption to be quite smooth for us. Now, I also see there's been a couple of questions about condo association fees. For us, you know, what that's done is it's actually driven owners to become renters, and a lot of them are selling condos off. So it's now creating a time period for us where we actually are picking up tenants, particularly at some of our other properties in the area.
Excellent. Anthony, another question here. Can you accommodate an investment directly into the QOZB level prior to the upcoming June 30th deadline? We oftentimes have a number of investors who have already funded their own QOF, and then they're now looking for a deal to deploy into. Is that something that you're able to handle, or that Sinatra is able to handle?
Absolutely. We actually do that for almost all of our deals, and we're very much set up for that. So if you already do have your own QOF, please let me know, and then we can work out the docs for that. Very easy for us.
Excellent. Another question coming in here asks, do you have construction financing in place and final costs bought out? And how does the fee on revenue work for the development period?
Yeah, so we're not bought out just yet. That's why our construction schedule is starting in January. But we are very confident in our construction budget because honestly, we have quite a bit of padding in there. In terms of, I'm sorry, what was the second half of the question, Jerry?
Second half of the question, let me see. I just closed it out. Let me see if I can find it again. Sorry. Let's see here. having a hard time finding it now.
I
Sorry
think that
about
was
that.
it was bought out and
Oh, here it's right here still. Do you have construction financing in place and final costs bought out? And how does
yeah.
the fee on revenue work for the development period?
Yeah, on the construction financing, we're at the term sheet phase, but we haven't signed it. Part of this deal is because we're actually doing a couple of tranches of debt. For this particular project, we're looking at putting in a layer of C-PACE financing in addition to the senior lender. So we're working through all of that, which is an added level of complication, but it actually then increases the returns for equity investors.
Amazing. That's a commercial property assessed clean energy tax credit, I believe, right? Or finance.
That's right.
Yeah.
That's right.
Let's see. A comment and a question from another attendee here who says, as an investor based in California, it's nice to know that you'll be calculating my potential tax liability and taxes that may look different from others, California being one of those non-conforming states. That investor will still access all the federal incentives, but California, you'll have a tax bill there. The question is, what is your minimum investment amount? And I think it was on one of your term slides. I believe it was $100,000. Is that right?
That's right. We're typically at 100,000. Sometimes we do go a bit lower for prior investors, or we've actually had cases where a couple of investors pull together. And in that case, they're collectively meeting that 100,000 minimum, and we'll bring them in together.
Perfect. Got time for a couple more questions here. Greg is asking about bonus depreciation. He wants to know, bonus depreciation, is that passed back in the year of deduction to the investor for his personal tax return? How does that work exactly?
Yeah, so that's a great question. Right now, what happens is in the year that we finish construction, which in our pro forma would be 2027. So for 2027, that tax year, you're going to get this K1 with this humongous loss. To kind of put it in numbers, for a $100,000 investor, you're probably going to get a $100,000 loss on that K1. This is in particular for high-rise buildings of this type of construction. We can actually move quite a bit into additional depreciable lives. So that all comes back as bonus depreciation. And then what we're also forecasting is after that, there's also going to be continued depreciation. So over the life of this particular project, right now the pro forma is almost 180,000 of depreciation total for a $100,000 investor. So that's a significant amount of tax savings that you can have. And as we heard in a prior presentation too, that with the beauty of the OZ benefit of having that 10-year step up past all those depreciation losses, none of that is recaptured, which is just phenomenal for us.
Fantastic. Well, Anthony, we've run out of time. I need to move on to our next presenter. I think there were a couple other questions we didn't get to. Please reach out to Anthony directly via email. I've just posted in the chat. Anthony, great seeing you at our dinner in Manhattan Beach earlier this month.
Fun.
Looking forward to getting together with you more on our OZ Insiders events. And thank you so much for your support of OpportunityZones.com and of today's event, OZ Pitch Day. Thanks, Anthony.
Great. Thank you.